We're looking at a common equity waterfall model capable of handling up to 22 years of yearly cash flows and for which we have also made available quarterly and monthly versions. This waterfall calculates the promoted interest, often simply referred to as promote, that the general partner, or GP for short, could earn depending on the IRR he is able to generate for the deal. And you could calculate the promote based on different profitability metrics such as cash on cash, equity multiple, cumulative distributions, etc. But in this case we are doing so based on IRR. The GP's promoted interest, or simply promote, is a disproportionately large share of total profits that the GP, who is the manager sponsoring individual deals, could earn based on the generation of positive returns. Now, disproportionately large in relation to what? Well, in relation to his initial investment. For example, in this fictitious case, he puts up 5% of the equity into the deal, so he is entitled to receive 5% of the equity distributions. That would be the pari passu distribution, and anything above that 5% of distributions would account as a promoted interest. The drivers in this waterfall are the inputs in blue font over a gray background. Those are the only inputs we are meant to be playing with, and all the other numbers we see are dynamic results and calculations. Our first set of drivers is of course the free cash flow to equity. This is the cash flow coming from and going into the investors' pockets. Free cash flow to equity is meant to be calculated independently in your own cash flow model and is usually the last line of the cash flow statement, right before splitting it into general partners and limited partners cash flow. The GP's equity contribution share is regulated here with the GP's participation input. So with this 5%, what we're saying is that out of the $1 million deal level equity requirement, the GP is contributing $50,000 and the LP or limited partner the remaining 95%. We can change this 5% to whatever other percentage we want. For example, we may set it to 0% and the GP wouldn't be contributing any equity in dollars, only sweat equity of course, and earning a promote on that sweat equity. Or he could, for example, contribute a 10% or whatever we want, in which case he would be contributing $100,000 of equity capital, just to mention an example. With the analysis start date, we can assign a calendar date into the time zero in the investment timeline. According to financial theory, time zero lasts a split second and helps us defining the beginning of the investment cycle, which is important for IRR calculation purposes. So conceptually, in this case, this first column lasts a split second and the following columns last 1 year each. We can change our currency symbol from dollars to euros to pounds. This has no effects on the calculations per se, it is only for reporting purposes. We can opt to calculate IRR hurdles on a compounded or simple basis. In the simple interest calculation methodology, interest is not capitalized in the calculation of the next period's interest. In other words, there is no interest on interest, whereas in the compound interest calculation methodology there is. Usually compounded is the most typical way of calculating IRR hurdles. In terms of hurdles and promotes, we have the following drivers here, and so in this example we are saying that from a 0% IRR to an 8% IRR, the GP gets no promote, which is normal because this is the LP's preferred return tier, so the GP is not supposed to earn any promote at this point. But then from an 8% IRR to a 10% IRR, he gets a 15% promote, which means that he is earning first 15% of the profit distributions in this IRR tier, plus his corresponding 5% share in proportion with his 5% share of equity contributions of the remaining profit distributions in this tier. Then from a 10% IRR to a 20% IRR, he gets a 25% promote, which means that he is earning first 25% of the profit distributions in this tier, plus a 5% of the remaining profits in this tier. And then finally he would receive 50% of all profits above a 20% IRR, plus his 5% pari passu profit distribution of the remaining profits. Down here we present the main return metrics any typical investor would like to look at, such as the IRR, equity multiple, contributions, distribution split, profit, payback period, and business plan duration. Now we're breaking this down by partner and we're also showing it at the JV level, meaning right before the GP-LP split takes place. But this summary is perhaps the most important piece of information of the whole model because it is answering the most fundamental questions anyone would think about when it comes to investing. How much money do I need to put in? When am I getting my money back? How much money could I make? Additionally, we show over here what the LP-GP cash flow splits are, which tells you how much each party is contributing and collecting and when, as well as this chart illustrating equity contributions, equity distributions, and outstanding equity throughout the holding period. And we can see how the waterfall plays out visually. In graph number 1, we can see how profits are being split by tier among LPs, GPs, and GPs promotes. So we can see the proportion of promotes at 15, 25, and 50% and how they match with the drivers here. We can also see pari passu profit distributions with the yellow and gray bars and how the GP in yellow is always earning 5% of anything after promotes and the LP always 95% of anything after promotes. So GPs and LPs always keep their 5 to 95 pari passu ratio. If I change the GP's participation say to 0%, then GP's pari passu profit distribution disappears. But he still earns his promotes for the sweat equity deployed to bring the deal all the way up to a 33.8% IRR. Let's switch back to a 5% participation and see how these dynamics play on a dollar amount basis over here. We can see how we have broken down the $3.5 million of profit by rate of return tier and also between promoted interest and pari passu profit distributions. So for example, at the 8 to 10% IRR tier, $13,000 correspond to 15% of the profits in that tier, $3,800 to 5% of the remainder, and $72,000 to 95% of the remainder. Now this $13,000 plus the $3,800 equals $17,280. Those $17,280 represent 19.3% of the profits in that tier. So in this graph we are highlighting the total profit share, including both promotes and pari passu profits, that the GP is collecting by rate of return tier. Whereas in this graph we are pointing out in what tier the GP makes most of his money. Naturally, the last tier would be the one where the GP collects most of his profits because the higher the return percentage point, the more dollars that percentage point represents. So for example, if upon exit, instead of generating $3 million of profit, we generate say $1.3 million, the GP still generates more profit in that last tier than in the previous tier, even if there are 10 percentage points in the 10 to 20% IRR tier, and only 5.3 percentage points in the last tier. But those 5.3 percentage points are higher in the value creation chain and therefore are more currency dense than the percentage points in the lower IRR tier. In graph number 2 we highlight how thanks to the promoted interest, which the GP earned as a performance fee for hitting higher and higher IRR hurdles, the GP's cumulative profit share increases from 5% to 43%, which we can see in dollars over here and in percentages over here. Finally, we've included down below a summary of cash flows for the JV, LP, and GP. First, we present here the JV level cash flows broken down by tier. So we can see the invested capital, the return of that capital, then the preferred return, and the 3 IRR hurdles along with its corresponding return metrics: IRR, equity multiple, contributions, distributions, profit, and payback period. Then we see the same for the LP, how he contributes his capital, when he gets his money back, when he hits that preferred return, and how his investment clears the different waterfall IRR hurdles. We also report his corresponding return metrics. Finally, we present the GP's cash flows in the same way, with the subtle difference that now we're further breaking down his different hurdle cash flows into pari passu profit distributions and promoted interest. So we have a clear idea of how much is promoted at each tier. So let's assume we have over here our typical cash flow in which we go all the way down from revenue to unlevered cash flow to levered cash flow. And for the sake of simplicity, let's suppose that we decide that our levered cash flow corresponds to the free cash flow to equity, which would be the stream of cash flows that we would like to split into LPs and GPs. In other words, we're neglecting any taxes or working capital adjustments, which are line items we sometimes would find after the levered cash flow line. So what we do is we copy our promotes waterfall model worksheet into the workbook of our cash flow model. Next, we link the free cash flow to equity into the waterfall model. And we make our timelines match by linking the analysis start date from our cash flow model to our promotes waterfall model. We define our currency symbol as well as our hurdles calculation methodology. We now determine the GP's participation. We define what our IRR hurdles would be along with our corresponding promotes. We can now finally proceed to link the LPs and GPs cash flows from our promotes waterfall model into our cash flow model to consolidate all flows into a single statement.